This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hello everyone, I'm Oldfish. Today I want to do an episode to take a look at the utility sector covered call ETFs on the market to see which one is the best. The reason is that I've been staring at my own portfolio these past few days, and the more I look at it, the more I feel the structure is too aggressive and lacks defense. QDAY, HHIS, QQCL, plus BIGI, these few actually account for half of my position, which means I've almost bet all my chips on the logic that US tech stocks will keep rising. Although I also allocated HDIV to diversify geographically into Canada, the defensive sectors inside it actually account for a relatively small proportion. And HYLD is more like a concentrated version of the S&P 500. The volatility is not low at all, and it doesn't really serve a defensive purpose. So I was thinking I must add a low volatility sector that has a low correlation with tech stocks to balance it out. So let's start this episode right away. In the screening process, I compared several ETFs, such as BMO's ZWU, Hamilton's UMAX, Haverst's HUTE, and Evolve's UTES. Although BMO's ZWU has the longest history, BMO's mechanical covered call strategy is not efficient. As for Hamilton's UMAX, the covered call coverage is 50%. Although the dividend yield is very high, the covered call strategy is a bit aggressive. We can see that the net asset value is constantly decreasing, and the dividends are also continuously declining. Although it's not to say its total return is negative, psychologically it's still a bit hard to bear. Both BMO's ZWU and Hamilton's UMAX do not have the 25% light leverage. If a covered call fund does not have the support of light leverage in the long run, it will severely underperform the underlying assets. So this is also the reason why I didn't choose them. I finally locked in Haverst's HUTE and Evolve's UTES. Of course, it's not just because these two performed the best this year, but also because of their structures. Let's look at Evolve's UTES first. This ETF is the best performer among the 4 ETFs this year. Including dividends, the total return this year reached 15.28%. If dividends are reinvested, the return reached 16.15%. Regarding the fund company Evolve, we talked about their bank ETF before. UTES is the sister ETF of bank. Unlike bank, which invests in the financial sector, UTES invests in the utilities sector. The configuration of UTES is slightly different from bank. UTES does not have a 33% cap on covered call coverage. This means the fund manager will try to write covered calls as much as possible while keeping the net asset value unchanged, and at the same time use 25% leverage to enhance dividend levels and returns. In terms of management fees, it is 0.6%, the same as bank. The current annualized dividend yield has reached 17.7%. Being able to reach such a high level is largely due to the high dividends of the underlying companies and a possibly more aggressive covered call strategy. In terms of holdings, it tracks the Solactive Canada Utility Index, which contains 10 Canadian blue-chip companies. Let's look at Hydro One, Fortis, and Emera first. These pure utility stocks in the holdings earn regulatory income. Simply put, the government allows them to have a guaranteed fixed profit return rate after investing in infrastructure such as power grids and water pipes. Regardless of whether the economy is good or bad, as long as everyone is still using electricity and turning on lights, their profits are rock solid. Then it also holds energy pipeline giants like Enbridge. In Canada, pipelines are actually the highways of energy. They sign long-term leases of 10 to 20 years. This quasi-utility model provides huge cash flow, and in an inflationary environment, their rents can often be adjusted upwards, so they are excellent inflation hedging tools. Finally, they also hold telecom stocks like BCE, TELUS, and Rogers. Although telecom stocks have been relatively weak recently due to interest rates and competitive pressure, their dividend yields are inherently high. More importantly, what the covered call strategy likes most is volatile stocks. The volatility of telecom stocks gives UTES more opportunities to harvest option premiums, thereby pushing the overall dividend to an amazing level close to 18%. Having said so much, what we might be more concerned about is whether UTES's covered call strategy has efficiently converted into cash flow. Let's look at the index tracked by UTES, which rose by 15.74% this year. Let's compare it with UTES's return this year. We will find that it is quite close to UTES's return this year. This shows that with the support of 25% leverage, Evolve's covered call strategy has relatively efficiently converted volatility into cash flow. Next, let's look at Haverst's HUTE. HUTE is the 25% leveraged version of HUTL. Compared to Evolve's UTES, its historical record is longer. We can see that HUTE's average return in the past 3 years has reached over 10%. Let's talk about its configuration first. Like UTES, it uses 25% leverage. In terms of covered call strategy, it uses 33% covered call coverage. This design is very smart. It uses leverage to amplify the dividends of global utility stocks, while using 33% covered call coverage to collect premiums in a volatile market without capping the upside potential in a bull market. Because it adopts a relatively moderate covered call strategy, the current annualized dividend yield is 9.64%, also paid monthly. Although it is much lower than Evolve's UTES' 18%, this is still a very good level in the global utilities category. Its management fee is 0.5%, which is slightly cheaper than UTES. What impresses me most is that HUTE has stepped out of Canada. Unlike UTES, which concentrates on 10 Canadian stocks, behind HUTE are 30 top global utility giants. It is very diversified geographically. Its holdings cover the United States, Europe, and other parts of North America. Although the Canadian utilities sector is very stable, it is extremely affected by local regulations and the Canadian dollar exchange rate. HUTE provides global allocation, which means that even if a policy in Canada is negative and causes local stocks to fall, HUTE can hedge against it with the performance of the US or European markets. Having said so much, let's finally look at the performance of HUTE. In terms of performance, HUTE's performance this year slightly lags behind UTES. But if we extend the timeline, its return is temporarily ahead of UTES. I personally really like HUTE's geographical diversification and covered call strategy. We can see that its net asset value level has been maintained well. Although the historical record has exceeded 3 years, its share price has been fluctuating at a certain level. Let's summarize. UTES focuses on the Canadian market and has an index logic, but the covered call strategy is slightly aggressive. The distribution level of HUTE is relatively conservative, but it has the advantage of global allocation and a relatively moderate covered call strategy. So if you value cash flow efficiency and want to fully utilize local Canadian tax benefits, then UTES, a tool focused on Canadian stocks with huge dividends, may be more suitable. But if you are risk-averse, hope to diversify assets globally, and don't want to bet your life savings entirely on the single market of Canada, perhaps HUTE can make you sleep more soundly. Investment has no absolute superiority or inferiority, only whether it suits your account at a specific stage. So if you have to choose between the ultra-high dividend UTES and the globally allocated HUTE, how would you choose? Or do you think this leverage strategy is still too aggressive, and the traditional ZWU is where you belong? Welcome to leave your views in the comments section. I am Old Fish. If you like my content, don't forget to like, comment, and subscribe. See you next time.